Today's lesson will be Chapter 2. We're going to be looking at recording transactions through T accounts. If you'll hold on just a minute, I'm going to share my screen with you. Okay, it's not working this time, so let me go back and see what the matter is. Okay, let me try it one more time. All right, you should be able to see your Chapter 2 notes. In this chapter, we're going to be doing several things that have to do with preparing journal entries and posting them to the ledger and preparing a trial balance. But in today's lesson, what I want to show you about are T accounts. And so the first thing that we need to talk about is what an account is. An account is a place where we're going to record increases and decreases in accounting. And there are several types of account classifications that we're going to use to help us to organize our accounts. These classifications you've heard about from Chapter 1 are assets, liabilities, capital, which is sometimes called owner's equity, revenue, expenses, and drawing. These are what we call account classifications. You might also remember from Chapter 1 that we had lots of accounts that make up these different types of classifications. So if we start with assets, an account that is associated with assets is cash. Cash, accounts receivable, supplies, prepaid insurance. Those are all examples of assets, as well as there are many others. And the assets would go underneath the account classification assets. So what we're doing in this chapter is we're going to further organize the information through what we call T accounts. And before we put them in T accounts, we're going to need to know what the account classifications are. They are assets, liabilities, capital, revenue, expenses, and withdrawals. So underneath liabilities, we might find accounts payable or notes payable. And in this chapter, we're going to introduce a new liability to you called unearned accounts. So if you see unearned revenue, that's a type of liability account and would fall underneath the account classification of liabilities. Capital, another word for capital, is owner's equity. And in the capital account, we're going to show when the owner makes an investment in the business, it's going to show up in the capital account. Capital account is an account type of classification. We also have revenue accounts that are a type of account classification. And what would go underneath the revenue account classification are things like sales, professional fees, services rendered. It could be anything that we've named our revenue account. If you'll remember from Chapter 1, we said that revenue was the work that we're going to be doing in our business, and that work or revenue can have different names associated with it. Sometimes we'll see fees earned as a revenue account. Under your expenses, you're going to find things like supplies expense, advertising expense, miscellaneous expense, rent expense. All of those are different types of expenses and would be found under the expense classification, account classification. And drawing is another word for withdrawals. You'll remember that the withdrawals are the amount of money that the owner takes out of the business. So all accounts are going to be listed under some type of account classification. And I've given you some examples again of accounts that would be listed underneath certain types of classifications. What you need to know about an account is that it's a place where we're going to record increases and decreases. And we can represent an account by drawing a letter T. If you look toward the bottom of this spreadsheet that I have made out for you, you can see that I have a bunch of T accounts that are listed here. They're shaped like the letter T. These are all what we call T accounts. And our accounts, our T accounts, will have a left side and they'll have a right side. The left side just means that that is the debit side of the account. Notice each one of the different types of account classifications that we've set up in T accounts all have a left side and a right side. The left side and the right side are the accounts that are the left side of the account is the debit side and the right side is the credit side. And I see that one of my expenses kind of got a little bit offline here. So let me see if I can insert a cell here and shift it down. Yeah, that makes it look a little bit better there. So each one of these are T accounts, just like I've got represented here. Each T account has a left side, which we call the debit side, and a right side, which we call the credit side. I don't want you to associate anything at all with the terms of debit and credit other than in accounting. Debit means left and credit means right. I know you all like to use debit cards and credit cards. That's something that the bank issues to you, and the bank looks at debits and credits a little bit differently. So the only thing I want you to associate with your accounting terms is that debit means the left side of an account and credit means the right side of an account. It's very important that you learn which side of the account increases on. If you will remember in the last chapter, we talked about the accounting equation. And in the accounting equation, the assets were on the left-hand side of the equals mark. You can see I plugged the equals mark in between these two accounts to show you that assets are on the left side and liabilities and owner's equity are over on the right side. The increase side of the account will be determined when you're just looking at the accounting equation, as assets are always going to be increased on the left side or the debit side. So I want you to learn that assets go up on the debit side. Liabilities will go up on the credit side. Notice they're on the opposite side of the equals mark. So liabilities increase on the credit side. Owner's equity also increases on the credit side. And so the opposite side of the increase side will be the decrease side. So your assets will decrease on the credit side. Your liabilities will decrease on the debit side. Your owner's equity will decrease on the debit side. The decrease side is opposite of the increase side. So what I would suggest that you do is learn the side that the account increases on. In other words, I want you to know that assets increase on the debit side, liabilities increase on the credit side, owner's equity increases on the credit side. The opposite side will be the decrease side. Now notice down below owner's equity, I've lined up my revenue with my owner's equity account because revenue adds to owner's equity. It is treated like owner's equity. So it has a normal credit balance, or revenue will increase on the credit side, just like owner's equity will increase on the credit side. Your expenses will decrease owner's equity. Notice I have these out to the side of revenue because when we prepared our income statement, you'll remember our revenue and our expenses went on the income statement, and the expenses pulled on the revenue. By deducting the expenses from the revenue, it would give you net income. Since our expenses will decrease let me rephrase that, since our total expenses will decrease our owner's equity, the balance for an expense account will be on the opposite side of our owner's equity account. So in other words, owner's equity had an increased side on the credit side of the account. Your expenses will be opposite of that. They will have an increased side on the debit side of the account. Remember, debit just means left, so expenses increase on the debit side because they're treated oppositely of owner's equity. The expenses in total will decrease owner's equity. That's why they're treated opposite of owner's equity. Your drawing or your withdrawals also decrease the owner's equity in total. So my total drawing will decrease my owner's equity or decrease the amount of the owner's worth. Because they decrease owner's equity, they too are treated oppositely of your owner's equity account. Notice I've lined up my expenses with my withdrawals because expenses and withdrawals both have increased sides on the debit side. They are opposite of my owner's equity account. Now, if you step back and you kind of look at these, you can see that assets, liabilities, and owner's equity were your balance sheet accounts. We still are going to be needing to know how to prepare a balance sheet, which you learned to do in chapter 1. Although we're not going to talk about it much in this chapter, it's going to come back and haunt us in the next chapter. So when you're looking at these T accounts up here, when you see assets, liabilities, and owner's equity, it should signal to you that this is a form of the accounting equation. And if you'll remember on our financial statements, the balance sheet, we reported it as the accounting equation. We listed all of our assets, all of our liabilities, and our ending amount of owner's equity on the balance sheet. You might remember that revenue and expenses went on the income statement. That's why I put these two together, because the income statement technically would be prepared as the first financial statement. It would consist of revenues and expenses. The second financial statement that we would prepare for proprietorship is the statement of owner's equity. You learned how to prepare one in the last chapter, and that had to do with your owner's investments, which would be your capital account. You combine your revenue and expenses to find net income. Your net income would add to your owner's equity, and then your drawing would decrease the owner's equity. So all of these are your owner's equity accounts. So these are your income statement accounts. This is owner's equity accounts, and these are balance sheet accounts. But what I want you to be familiar with and to learn in this chapter is you need to learn which side of the account increases on. Assets increase on the debit side, liabilities on the credit side, owner's equity on the credit side, revenue on the credit side, but expenses increase on the debit side and drawing increases on the debit side. Once you know all of the account classifications and the sides that they increase on, the opposite side will be the decrease side. So my assets increase on the debit side. The opposite side is the credit side. That's the decrease side. Liabilities increase on the credit side. The opposite side is the debit side. This is the decrease side. So the opposite side of the increase is the decrease side. The next thing I want you to learn is that your balance side of the account should always be on the side of the increase. For assets, the assets increase on the debit side, so that should be its normal balance. That's not to say that sometimes it'll go over here to the credit side, but that's not normal. And if that happens, then usually there's something wrong with your asset accounts. So you need to go back and try to figure out what's wrong with them or what's wrong with your transactions. The normal balance side should always be on the side of the increase of the account. So assets balance will be on the debit side. Liabilities balance will be on the credit side. Owner's equity balance will be on the credit side. Revenue balance will be on the credit side. Expense balance will be on the debit side. Why? Because these are the increased sides of the accounts. Owner's drawing balance will be on the debit side because that's the increased side of that account. It's very important that you learn these account classifications and the side of the increase, because the next time we meet, we're going to analyze transactions through this accounting equation. So I'm going to stop sharing here. And I will stop the recording. Bye-bye.